All right, folks, today I'm going to try something new. Let's see if it works the way I hope, because I have a camera recording me that's right in front of me, but it's kind of low, so it's looking up, and it may be a little bit weird, but we'll give it a try and see how it plays out, and then we'll figure out what we're going to do for future videos. But today I want to talk to you about a concept that's very important in investing, and I've talked about it in the past, but you may not have caught on. And the concept is the drawdown concept. So let's go ahead and take a look at the computer and see what I mean by that. So what I have here is Portfolio Visualizer, and I'm putting in here a portfolio that is 100% stocks in Portfolio 1, and then 100% bonds in Portfolio 2. And this is just using the US stock market and the US bond market. I'm running it for the maximum time period that Portfolio Visualizer has data for. So the result is showing from 1987 to 2022. So that's quite a bit of time. We're talking something like 39 years here. And over 39 years, this is the result for 100% stocks and 100% bonds. Now, the important thing to realize here is that these are nominal returns, so they're not real returns. If I hover over the I here, it tells me that if you were in 100% bonds adjusted for inflation, you would have a CAGR of 2.26% per year. Conversely, if you were in stocks 100% of the time, you would have had a CAGR of 7.07%. Now, the challenge is that if you are using your portfolio to live off of, 2.26% after inflation is not going to cut it for a 30, 40-year retirement time horizon. 7% would do it. But the problem is that the 7% after inflation is not steady. And that's where people try to mix stocks and bonds. And the reason they do that is this concept of max drawdown. So when you look at max drawdown for the 100% stock portfolio, we're looking at almost 51% max drawdown. Whereas with bonds, it's a lot less at 17%. What does this actually mean? Well, if you run this analysis in Portfolio Visualizer, there's actually a drawdowns tab that's to the right here after summary in the result. And if you click on it, you can see what this means. So the blue is the 100% stock market, and then the red is the 100% bonds market. So you can see that before 2022, the red line didn't actually go down all that much. So if you could live on, say, 2% returns, that's not a bad investment, right? Because when you're going down maybe 3.67 is the most that I see before 2022. Is that about right? Call it 5% is the max before 2022. 2022 was one of those once in a lifetime condition for the bonds market where it was down 17.5%. That's very highly unusual, but that would have been the max if you were to look over this time period. But when you look at stocks, it's a lot deeper. Back in the Great Recession, we were down almost 51%. And before that, in the tech bubble burst, we were down 44%. Now, drawdowns by itself is not a huge problem if it recovers quickly. Here we are in the pandemic in March 2020, went down 21%, but then it got back up to zero by July 31st. So not a very long drawdown at all, 4 months. If you scroll down the page here, you can see that for the 100% US stock market, you could possibly have a drawdown of almost 6 years. What this means is that from the time that it started to the time that it recovers, you are underwater. You didn't make back your amount that you started with for almost 6 years. Okay? Whereas with bonds, the worst that has happened was just a little over a year. But the problem there is that this is not a good enough returns over the long term after you adjust for inflation. And that's why people combine the two. So let's redo this, but we're going to focus on the 2008-2009 crash, just to focus on drawdowns so you can see what this means. So we go back to, call it 2005 to 2010. I'll remove the bonds so that we don't get confused by it and rerun this. So now I'm shortening the time frame to cover the Great Recession. So we can see that over this time period, the CAGR was still positive over these 5 years, 3.44. The problem is right here. This is this big drop. And to be fair, I probably shouldn't even take it to 2010. I should take it longer because we need to see when it recovers. So let's go the full 10 years from 2005 to 2015. So let's analyze this. And then again, we'll go to the drawdowns. And you can see that massive drawdown. Okay. So what's a drawdown? Drawdown is basically when you get to the peak of returns and then to the next trough, the next bottom. So if we go to the summary here, we can see what this means. So the peak was probably back in November of 2007, end of October, November 2007, where the US stock market was at 13.6 if you had invested your $10,000. From this peak to the trough, which dropped down to 66.80, that was a 51% drop. Now the trick is that in order for you to recover, to get back to your initial 13.6, you're not going to get there until not even here. This is 13.4. You're still underwater. You have to wait until you get to this time period to get back to 13.6. So February or March of 2012. Okay? So from November 2007 to February or March of 2012 was the whole time that you were underwater, meaning that your portfolio was lower than the last peak that you started from before you had this drawdown. And if we go to the drawdown page, this is what we should see. So here we are. So this is the subprime crisis. But when we go down the drawdowns, you can see that it started in November 2007, like I said, and it ended around February or March of 2009. So the recovery was 3 years and 1 month to recover to the peak, but then you were underwater when you went negative by 4.5 years. That's a lot of time. This is an important concept because a lot of people don't realize what a 51% drop actually means. So let me illustrate it another way to show why this is important, even if you're not drawing down money. All right, so here we have a portfolio that you put in $1,000 starting in year one. And if you had a bad year, like we did during the subprime Great Recession, and you go down 50%, this is an easy math to do. You drop from $1,000 to $500 in year two. That's a 50% drop, and it can happen. It's not unusual for 100% stocks. If you were to recover in year three, you would actually need a 100% increase from your $500. So you're basically starting from 500. To get to 1,000, you have to double that, and that's a 100% gain. And that's the problem. In this chart here, I'm showing it over 3 years, but in reality, that doesn't happen. So you could drop 50% in 1 year, but then you may make 20% in the next year, another 15 the year after that, so on and so forth. But it would take you a 100% gain from this point in order to get back to just zero, what you started with. And the problem with drawdowns is that if you are in a protracted, deep drawdown and you need the money, you don't have the money to spend. That's problem one. But it's even worse because even if you're in the accumulation phase, it can cause you to be discouraged because you're adding money to the account all this time, but you're still underwater, right? You're not seeing it go back to where you started from. And that can be very discouraging and can make you give up on your plans. So in any case, this is a very important concept that I will mention quite a bit in my videos, but it's important for you to realize what it actually means when I say drawdowns or maximum drawdowns. Anyways, I hope you enjoy, and I'll see you next time. Bye.